Good morning, everyone. Hope you're all doing well. As I mentioned, and as I also included on the announcements page, you'll be having your midterm, again, your final, which is going to be on McGraw-Hill, and your final is going to be next Tuesday, a week from today, from 11 to 1 o'clock, 11 a.m. to 1 p.m., and it's going to be cumulative. Okay, so please keep that in mind. It's going to consist of 50 multiple choice questions. And keep in mind, really, the only new things that we hadn't discussed earlier really are going to be chapters, the last two chapters, which is last three chapters, chapters 18, 20, and then a little bit of chapter 14, which I'm going to give you today. So Nahid, yes, we've had two midterms so far, yes, and then the final, and the quizzes as well. Okay, so all of your grades are on Blackboard now, so confirm your grades, okay? Just take a look at them, make sure that they're accurate based on what you saw on McGraw-Hill. Okay, and we're going to continue from there, okay? Let's just see our Apple investment, what's going on there. Okay, our Apple investment, okay, it was trading last time we met at $123.04. Today it is trading at about $123.88. So it's a little bit of up and down, but overall it has increased in market value. Again, Apple, this is its biggest retail month. Okay, so you would anticipate seeing a bit of a surge in that market price as long as their product line and their sales are at an expected level. Okay, so now today we are going to complete chapter 20. All right, now chapter 20, remember, is on cost, volume, profit analysis. So remember, when we're discussing cost, volume, profit analysis, we are looking at the way that costs behave. Okay, why are managers interested in the way costs behave? Because if they understand how costs behave, they're going to be better able to control them. Okay, now the three different costs that we're going to be talking about in CVP analysis are fixed costs. Okay, we're familiar with these definitions. Remember, fixed costs, okay, which remain flat or remain stable within a certain relevant range. Also, variable costs. Variable costs, remember that when we think of what the slope of the variable cost line out of the slope of the variable cost line in total typically is going to look an upward slanting line. Okay, but remember also that when we're looking at CVP analysis, we're also going to be looking, now this is what variable costs look like in total. Okay, that upward slanting line. But remember, when we're considering, what variable costs look like on a per unit basis, okay, on a per unit basis, who remembers what does the slope of a variable cost look like on a per unit basis? Okay, with the cost being on the y-axis, it's not downward. This is variable cost. This is cost, and this is units. Straight, very good, Lysander. On a per unit basis, okay, and this is why we're really looking at how costs behave now, so that we can try to control them. Remember that within the relevant range, the per unit graph of what variable cost looks like is going to be that flat line. Okay, and that's because, remember, when we were looking at the airline example, remember that the cost of fuel, okay, is going to be 10 cents per gallon, okay, regardless of what the number of passenger miles are. So it is that flat line, okay? If we look at variable costs in total, yes, the more passenger miles we fly, the greater the related cost would be. But if we look at it purely on a per unit basis, since the per unit cost is the same within that relevant range, that's what that's what the graph of a variable cost would look like. No, it would be a flat line. Okay, I'll show you the stair cost again in a few minutes. Okay, we'll go over that for you, Rachel. And then I just see another question, Dante. I'm a little confused on where 20 points in my final grade have gone. But I got 95 and 96 on the midterms. You know what? Talk to me afterwards, because it should be whatever your midterm grade is, and then your quiz grade added to the top of that. Okay, and there's no 120. It should be out of 110. Yes. Okay. No, I think Blackwood, I'll check it, but it should say out of 110. Okay. All right. So that, and then the third type of cost that we're going to be looking at are the semi-variable costs. And remember, semi-variable costs are those costs that, like a utility cost or your telephone bill, those costs have a flat. Okay, let's say for the connection fee, you know that even if you don't use your phone, you know you still have to pay that connect fee, a flat sum every single month. And then in addition, typically you're going to also have a variable portion of your bill. Okay, and that type of cost is considered a semi-variable cost. All right. Now also just to remind you, when you're talking CVP, okay, remember that the income statement for CVP analysis is also going to look different. Okay, and again, why? Because we're looking at costs, we're trying to control the costs, so we're going to separate them based on what their, how they behave. Okay, so we start our income statement, we always begin with revenue. So we're going to start with the sales revenue. Okay, but now when we're doing CVP analysis, what we're going to do, the first thing that we're going to deduct, who remembers? When we're doing the CVP income statement, what is the first variable cost? Excellent, Christian. First, we're going to subtract the variable cost. Remember, when we were dealing with merchandisers or manufacturers, first we had subtracted the cost of goods sold. Here for CVP, we are going to subtract all of the variable costs first. Okay, so we have the variable costs. Then we're going to get a subtotal, and this subtotal is very important for CVP analysis. The subtotal is going to equal the contribution margin. Okay. Then after we arrive at the contribution margin, the next thing that we are going to deduct are the fixed expenses. Very good, Lysander. The fixed cost, the fixed expenses. Okay. Then after we subtract out the fixed cost, and again, remember here, we're subtracting costs based on how they behave. All right, then when we get to the bottom line, the last line on a CVP analysis on that income statement is going to then give us the operating income. Okay. And again, operating income differs from net income because it does not consider the tax effects. Okay, any income taxes that are going to be deducted, because income taxes really are not considered either a variable or a fixed cost. It's more or less like an administrative cost or a tax by an outside authority. So income taxes are not considered when you do CVP analysis. Okay, so always remember which income statement. Again, the bottom line is usually about the same. Okay, if we subtracted income taxes from here, this income statement would look the same as the income statement that we had when we looked at manufacturers. Okay, it's just the way that we are dividing the costs. Okay, so just keep that in mind. All right, so we'll continue with the slides. All right, so, and we had also, and we were looking at the graphs, again, we were looking at some of the graphs for our cost. Here's in total what the fixed cost line looks like, the variable cost line, and the semi-variable cost line at different units of production. Here, since we were looking at an airline, we were looking at different amounts of passenger miles that are flown. And then here, if we put all of these three different lines on a graph, these three different expenses on a graph, this is what it would look like. And for 200,000 passenger miles, 300,000 or 400,000, and this would be the total related costs at each of those operating levels. Okay. We had also discussed something called economies of scale. Absolutely, there will be a definition, and that will be referred to in the final exam. Because remember what happened when we had economies of scale. What happened is that the cost, okay, per unit. Here we see that if we flew 200,000 miles, the cost per unit or the cost per passenger mile would be 31 cents. If the airline flew 300,000 passenger miles, the cost per passenger mile would become 24 cents. But look, if we flew even more passenger miles, that's 400,000 passenger miles, here the cost per unit would become 20 cents, 20 and a half cents per unit. So why is it that the cost per passenger mile actually decreases as the number of miles that we fly increases? Okay, and that's due to economies of scale. Okay, because here, since this particular airline has such a large portion of fixed costs, of fixed expenses, what happens that when you increase what the driver is, okay, the cost per unit is going to decrease, okay, because you're spreading those fixed costs over a larger number of units. All right, so very important function within CVP analysis. And again, here, this is what we see, how the cost per mile is actually decreasing as the number of miles flown increases. Okay, and that's what really intensive industries where there's a high amount of fixed costs, such as utilities, airlines, car manufacturers, since they have such a large chunk of fixed costs that they have to cover, they try to maximize the amount of production in order to lower their per unit costs. Okay, but again, something that you have to keep in mind is if you produce all of those extra units, you have to be able to ensure that you're able to sell all of them as well. Okay, but for our purposes, for our CVP analysis, we're always just assuming that the amount that we produce, we're able to sell. Okay, so we're looking at it in a little bit more of a simplistic manner for this class. Okay. All right, so, okay, how costs behave on a variable versus a per unit basis. Economies of scale, again, remember this definition. Economies of scale refer to the reduction in unit costs, okay, by using the company's productive assets more efficiently. Okay, so you have the set amount of fixed costs, again, within that relevant range, okay? And then as the level of production increases, what happens is that the fixed costs that each unit has to absorb actually decreases. Okay, and so that's what a good CEO, CFO, production manager, that's what they look to. Okay, and that's really what we're going to be seeing in a little while, how we deal with economies of scale and CVP analysis to determine how much we're going to produce. Okay, so here I think, Rachel, you asked me about a step cost. A step cost is just a different cost behavior pattern. And a step cost basically happens when you have the cost is flat over a certain volume, and then you see a steep increase in that cost, and then that cost remains flat over a certain level of production again, and it keeps happening. Okay, it's like a staircase. It resembles a staircase. And what happens in this instance is that, let's say between 0 and 100 units, you only need one supervisor, okay, to supervise your production. However, once you hit that 101 units, okay, let's say that there's a union requirement that you have to now hire a second supervisor. So again, you're going to see a steep increase in cost because now you have to cover that supervisor's salary. Okay, but that supervisor then, that cost then becomes flat, and then you have the workers that the wages of those workers also becomes flat within a certain range. And then what happens once you get beyond that range, let's say beyond so between 101 units being produced and 200 units being produced, again, the cost the cost in total is flat. Okay, but once you manufacture 1 unit beyond, okay, what that range is, again, you see that steep increase in cost because of the fact that you have to hire another supervisor. Okay, so that's what a step cost is. When you see those steep increases and then you see the cost flattening out for a while before you see another steep increase. Okay. And then here, another line. Typically, again, when we're talking about plotting points on a graph, typically, again, as we're going to see here, when we look here at this graph, usually remember this from high school when you were looking at standard deviations. Okay, typically, again, here we're looking at volume of output, and we're comparing it to the related costs. We say it's a straight line. Okay, but remember the slope of that line, we're trying to get to the straight line that has the least deviations, right? Less standard deviations. Okay, what you have to remember that when we do CVP analysis here, we're really just dealing within a certain range of activity, and the range of activity that we're going to try to predict costs in is going to be the relevant range. Okay, again, we're not looking to predict cost at very low levels of output or at very high levels of output. Okay, but remember, under very low levels of output, we don't have enough units to spread the costs over. At very high levels of output, again, we start to encounter things such as excess sick out time. We have to absorb overtime costs by our employees. So we're not trying to predict costs in either of these extremes. We're talking about predicting costs in CVP analysis within this relevant range here, which approximates a straight line. Okay, so it's not exact, but again, we're looking for the line that incorporates the majority of the points of production that are plotted on it. Okay. Okay, so now we're going to get down to the really important stuff in this chapter. Okay, so remember that when we're talking about CVP analysis, operating income, okay, remember on the income statement, we're going to start with the revenues or sales revenues, just like we had in the past. Then we subtract the variable costs, okay? Then we get the contribution margin. Then we subtract the fixed costs from the contribution margin, and that gives us our operating income. Okay, so here, when we're looking at cost volume profit analysis, realize that it's a really important management tool. And you don't have to be an accountant to use CVP analysis. Okay, you can be, and we're going to see in a little while examples. You could be in advertising, you could be the plant manager, you could be the president of sales. A lot of different responsibility areas are going to utilize CVP analysis. Okay, the most important point and the starting point in CVP analysis is the break-even point. Okay, and that, remember, the break-even point means that revenue, the total revenue, exactly equals total cost. Okay, because at that point, at break-even point, there is no operating income. But you know that once you produce 1 unit more, you are going to start to produce operating income or earn operating income at that point. Okay, so a break-even is defined at the activity, at the level of activity, which operating income is equal to 0. Okay, you're just covering all of your variable and your fixed costs at that point. But realize we're going to see once we look at what the formula is for figuring out what the break-even point is, whether it's in units or sales dollars. Once we figure out break-even, we can then figure out what level of units we have to produce to arrive at any operating income that we want. Okay, so really, really effective tool. Again, here, when we're talking about CVP analysis, we're referring to operating income, not net income. And that's basically because income taxes and non-operating gains and losses, we're not going to consider them in our income statement. Okay, and that's all I would worry about there. All right, everybody ready? Everybody sit up a little higher in your seat. We're going to go through this example now. Okay, so now we're looking at a snowboard manufacturer, and this snowboard manufacturer is called Snowglide. Okay, now they're currently based in the West, in Colorado and Oregon, and because of the popularity, now they want to start selling some of their units in the East. Okay, but what they have basically consistently determined is that they're able to sell their snowboards for about $90 per snowboard. So that's their expected revenue, total revenue per snowboard, $90 per board. Okay, so now look what happens. This is a CVP analysis that we're looking at here. Okay, and here we're just looking at it on a per unit basis. Okay, typically when you look at CVP analysis, we're going to see in a little while that we're going to deal with these costs on a per unit basis and also in total. Okay, but here, just to start our examination, and again, always set it up this way, or this is probably the way it'll be presented to you. Here, you're going to start with the revenues or the sales dollars on a per unit basis, which we were just told was $90 per unit. Then, okay, so this is already set up in terms of the same way we're going to set up our income statement. First, now we're going to subtract all the variable costs per unit, such as direct labor, direct materials, manufacturing overhead, and look here, even the variable administrative expenses. As long as it's a variable cost, it's going to be subtracted on the top directly from sales revenues. Okay, our total variable cost for producing that board is $36. Okay, so if we take the $90, which is the average price per board, we subtract out the $36 in the variable costs. What does that tell us? It tells us that our contribution margin is $54 per board, meaning that based on every single snowboard that we sell, approximately $54 of that revenue stream is going to be used to cover fixed costs and any operating income. Okay, we're going to see also that when we're doing CVP analysis, we're also going to look at percentages as well. Okay, what I want you to remember is that sales revenue, and we're going to do this on the income statement, sales revenue is always equal to 100%. Okay, because that's the total amount of revenues that are coming in. That's what we're going to be subtracting all of our expenses from. So the revenues equal 100%. And then here, we're going to add up all of our variable costs. If we divided $36 by the $90, we'll see that the total variable cost per board is about 40% of the sales price. And then just by subtraction, or you could say $54 divided by 90, we'll see that the contribution margin ratio, okay, this contribution margin ratio, the CMR, okay, equals 60%. Okay, per unit, meaning that 60% of every sales dollar is going to be used to cover the contribution margin, which is used to cover fixed costs and the operating income. Okay, so this is a really important ratio, the contribution margin ratio. And then after we have the contribution margin ratio and the contribution margin in dollars, now we'll see below that, just like on the income statement, we have all of our fixed costs being deducted. Okay, and we see here that our total fixed costs, okay, for producing these snowboards on an annual basis, our total fixed costs equal $37,800. And typically in all the examples, you're going to be given this information, all of the variable costs, all the fixed costs. You just have to know how to apply them. Okay, everybody good? Okay, So, okay, Joshua, is there a breaking point, the contribution margin, so that if it's too high or too low? What can the company, we'll see what happens then. We're going to see in a little while. So the break-even point is when, all right, so let's look here, Joshua. This will answer your question. If we look here, this is the monthly CVP graph. Okay, so we see here, what have we graphed here? We'll see this green line here. Those are the total fixed costs that are being plotted there. And we just saw how the fixed costs on a monthly basis actually equal $37,800. Okay, those are the fixed costs. Then what else do we see? On top of the fixed cost, we see that there's also variable costs, which are going to be incurred. And these are the variable costs that are being plotted on this line. Okay, and here, how do we plot it? Based on these different activity levels, we saw what the if we took the fixed cost, add the variable cost, we saw what the total cost line. So this is the red line here is the total cost line. Okay, now, okay, the first thing that we're going to consider in CVP analysis, we want to know what the break-even point is. Okay, so the break-even here, we're going to plot the revenue line here, this black line. So what happens here? Okay, here where the variable cost, where the total costs equal the total revenues, that is the break-even point. Okay, so here, if we could see here, the break-even point, if our production is below the break-even point, we see that we're going to incur a loss. If our production is above the break-even point, we know that we're going to be operating at a profit. Okay, so that's why the break-even point is so important. Okay, now, Joshua, answering your question, if you're a good manager, if you're in a competitive global environment, okay, what do you want to try to do with that break-even point? Okay, you want to try with operating efficiencies to try to move that break-even point more to the left, right? Because you want to reduce your break-even point so you're able to generate a profit at a lower level of productivity. Okay, but here, just think of it this way. And yes, if your break-even point, if you think that you're not going to be able to sell that many units, okay, in order to start generating a profit, then yes, then you're going to have to reconsider reviewing your business model. Okay, so you want to strive to try to lower your break-even point. Okay, but the break-even point is always where your analysis begins. Okay. And then Francisco, excellent question. Here, when we're dealing with the break-even point, we're only dealing with variable costs and fixed costs. Okay, at the end of this chapter, that's when we're going to look at semi-variable costs, because semi-variable costs really have to be dealt with a little bit differently. Okay, so excellent question, but we're going to deal with that a little bit down the road, and that's called the high-low analysis. Okay, that's going to go back probably for a lot of you back to some of your high school math when you look at when you're plotting, when you're doing the high-low analysis. It might come back to you. Okay, but very good point. But just right now, when we're dealing with break-even, we're dealing with variable and fixed expenses separately, just those two. Okay, very good. Okay, you're welcome. You're welcome. All right, so this is what we're talking about here when we're doing break-even analysis. Okay, so everybody ready? Okay, remember fixed costs are $37,800. So let's move ahead. All right, these are some of the key, these are some of the key formulas that we're going to deal with in this chapter. When we're talking about the contribution margin, okay, and remember, we're always working off of our income statement. The contribution margin is always going to equal revenue minus the variable costs. Okay, that's how we figure out the contribution margin. When we're talking, and that's in total. Okay, this is in total what the total contribution margin is. Okay, same way when we're dealing with CVP analysis, we're also going to be dealing with the contribution margin on a per unit basis. So again, same thing, if it's a contribution margin per unit, we're just going to take the unit selling price minus the unit variable cost. Okay, remember the example, the Snow Glide example, the contribution margin per unit equals $54. because we had revenues of $90, variable costs of $36. Okay, so our contribution margin per unit was $54. Okay. And then our contribution margin ratio, okay, was always the contribution margin per unit here, which was the contribution margin per unit, as we saw, was $54 per unit, right, on the earlier slide, and then divided by the unit sales price, okay, which gave us a contribution margin ratio of 60%. Okay, so this is always the way we're going to be looking at these three different formulas. From any of these three formulas, we're going to be able to figure out how many units the company has to sell in order to generate a certain operating income, or how many sales dollars the company has to basically sell, what total sales dollars they have to have to arrive at a certain operating income. Okay, so everybody ready? Okay, so look how powerful a tool CVP analysis is. All right, so we already talked about. All right, so now we're going to answer the elusive question: how many units do we have to sell? So here CVP gives us a really easy way to figure out what our break-even point is, okay, and also how we reach our desired operating income. How many units do we have to sell? Okay, and also break even could be really important if we're looking to see, like we just saw with Snow Glide, should we expand our production now to try to sell our units on the East Coast? Should we introduce a new product line? Maybe we want to sell helmets, ski helmets also. Okay, all these formulas help to really, and again, they're doing as if analysis. If we do this to our costs, what is the result on our total operating income? Okay, so very powerful tools. All right, so this is one here. When we're trying to figure out how many units, okay, and it doesn't matter what the product is, how many units do we have to basically sell in order to break even? Okay, here, remember that we saw the contribution margin was $54 per unit from the snowboard example, and we knew our total fixed costs equal $37,800. We got this information from the income statement. So in order to reach break even, okay, the formula is always going to be total fixed costs, okay, total fixed cost divided by the contribution margin per unit, okay, and we could do this for any product we want. Okay, we will always be able to figure out break even by taking the total fixed costs here, which we saw were $37,800, divide by the contribution margin per unit, $54. So our break even point for Snow Glide equals 700 units per month, okay, to just basically cover all of our expenses. All right, so again, if we sell 701 units, we now are generating operating income. If we sell 699 units, we actually are operating at a loss. Okay, but now look what happens. CVP analysis is such a powerful tool. We could take that same formula, and then based on whatever we want our operating income to be for that particular month, all we have to do is add our targeted operating income, okay, any desired operating income that we want, okay, that we feel is realistic, okay, plug it into that same formula. So here we have the fixed costs, okay, and let's say now that management decides that they want to generate a profit of $5,400 per month. Okay, in order to generate operating income of $5,400, at the current contribution margin, how many units does this company have to manufacture and sell every month? They have to sell 800 units. Okay, so you could see now how powerful this is. You could sit down with the top executives and say, okay, we want our operating income to be X amount, okay, over the next month. How do we do that? How many units do we have to sell? How many and produce? Here we could sell. We could substitute any operating income here for this figure to figure it out. Okay, so this is how we find out break even in units. Okay, fixed cost divided by contribution margin per unit in dollars. Okay, now another way, and it just might be that you're given this information in a little bit of a different format. How do we find out the required dollar sales volume? Okay, in order to generate a certain operating income. So now I'm not asking you how many units do I have to sell. I'm asking you what do our total sales dollars have to equal in order to generate a profit of $5,400. Okay, you just tweak that same formula, you just tweak it a little bit. So to figure out sales volume in dollars, okay, again, you're going to take the total fixed costs, which is the 37,800. You're always told that. You're still going to add the targeted operating income to the numerator here, 5,400. Okay, and if you want to figure out total sales dollars, instead of dividing by the contribution margin in dollars, you're going to divide by the contribution margin percentage. Okay, the contribution margin ratio. So when you do this analysis, you're going to determine that you have to sell $72,000 of snowboards. Okay, your total sales dollars have to equal $72,000 in order to generate operating income of $5,400. And again, here you could substitute any figure, any operating income you want. Okay, that formula within the as long as it's within the relevant range, that formula is going to hold. Okay, and remember, just for the final, you have to know, because you're going to be given some questions where you have to figure out the sales volume in units or the sales volume in dollars. Okay, and here we could have taken, if we knew the sales dollars, the sales volume, if we knew we have to sell 800 units in order to arrive at the operating income of 5,400, we just could have multiplied the 800 units times the $90 sales price, and we would have come up with the $72,000. On the final, though, we have to make it a little tricky. The way the problem will be set up is that you won't be able to double check it that way. You'll have to know the separate formula. And again, the difference is just, it's just the denominator, whether it's fixed cost, whether it's contribution margin in dollars or contribution margin ratio. Okay. Again, pretty simple, right? Some pretty simple tool, but very powerful. Okay. So after we know what our break even is, after we know what basically are the units that we have to produce to arrive at a certain operating income, there's another analysis that that you could do, and it's called the margin of safety. Okay, margin of safety, all that it is that you start with actual sales and you subtract the break-even sales. Okay, so actual sales minus break-even sales equals the margin of safety. Okay, actual sales dollars, actually. Actual sales dollars. Actual sales dollars less the margin of safety dollars, margin of safety sales. Equals the margin of safety. And that makes sense, right? How much of a cushion do I have above the break-even point that I'm actually operating at right now? Okay. So here, the margin of safety also represents the dollar value that sales can decline. Okay, it represents the amount that sales can decline before an operating loss is going to be incurred. So remember, if we looked at that graph, it's like that upper triangle, right? That's going to be considered the margin of safety. Okay, above the break-even point. So let's take a real example. If our total monthly sales for this month, okay, if our total monthly sales, actual sales, equals $73,000, okay, here, if we go back and we plug into, if we figure out on with our other example, what our sales volume at break even is. Okay, our sales volume at break even, again, how do we figure that out? Total fixed costs divided by the contribution margin ratio. We see that our break-even sales dollars for snowboard is $63,000 per month. That's our break-even sales, right? If our actual sales are $73,000 for this month, what does that mean? That means we have a margin of safety of $10,000, right? Pretty straightforward, right? Actual sales, 73,000, above break-even sales, 63,000. We see what our margin of safety is, okay? The nice thing is, look how convenient that is. Once we determine what our contribution margin ratio is, okay, we can figure, and we know what we want our margin of safety is, we can figure out what our operating income is going to be at any sales dollar value. Okay, so here, all right, if we take the upper example, if our margin of safety, okay, based on the above information, is $10,000, right? If our margin of safety is $10,000 and we know our contribution margin ratio is 60%, okay, we can determine from that what our operating income is at that point. So we see at that level of activity, okay, our operating income is going to equal $6,000. Okay, margin of safety times the contribution margin ratio. Okay, and again, this is what's the sales level at this point? It's $10,000 above the margin of safety, which equals $73,000, right? Okay, what if we want our margin of safety to equal $15,000? Okay, if we believe we can increase our margin of safety to $15,000, and that basically means sales of how much? Sales of $78,000, right? Because we take the margin of safety of $63,000, add $15,000 to it, our margin of safety now is $15,000. Okay, if we want our margin of safety to equal $15,000, okay, what would our operating income at that point be? We'll take the $15,000, multiply by the contribution margin ratio, and what is our operating income going to equal? With a margin of safety of $50,000, our operating income is going to equal $7,800. So again, if we look at the margin of safety, it's a really quick way, okay, to determine what our operating income is going to be at any level of sales. Okay, so really neat, quick analysis that we could do. All right, and it's always just going to be, and remember, the margin of safety is actual sales less break-even sales. Okay, and again, management sits down at the beginning of every year, also throughout the year, to determine, okay, obviously they want to maximize their operating income. How do we get to the operating income that is desired at this point? Okay, just a quick, easy analysis. Okay, all right. So now we're going to do further analysis with this particular problem with Snowglide. There's just something here, just a general overview. Remember, CVP analysis is not only for accountants. Okay, we're going to see now several ways that different people in management get together and they determine what their production is going to be for the coming year. Okay, and again, once they determine production, they're going to then determine what their revenues are going to be, what their variable costs are going to be, and then also what their operating income is. Okay, now we're going back to what our original example was. Remember, Snowglide, that snowboarding company, wanted to start expanding sales to the East Coast now. Okay, now different managers are sitting down in a meeting, they're getting together, and now they're figuring out, okay, how they're going to grow this company, okay, how they're going to focus their operations and their production, okay, because now they're implementing a new market strategy. All right, so you don't have to be an accountant to utilize this type of analysis. Okay, so currently right now, based on the example that we were using earlier, so everybody sit up a little higher, okay? This is our last chapter, so everybody, and it's really interesting, okay? So here, assume that Snowglide is selling approximately 900 snowboards every month, okay? That's their current production, and we also know that they're selling it currently for $90 per snowboard, okay? In response to the new market strategy, okay, so now all management is coming together and saying, okay, how are we going to grow this company? The director of advertising is asking for an increase of $1,500 in her monthly budget. She plans to use these funds to advertise. Okay, so if she is asking for an increase of $1,500 each month, okay, what's happening here? In this example, she wants to increase the fixed costs, right, by $1,500 every month, all right? And now, why does she want to increase the fixed costs by $1,500? She believes that if they increase their fixed costs, and again, this is for advertising, that they're going to be able to sell 500 more snowboards every month. Okay, and again, this is an as-if analysis. She's coming in with this presentation. This is what she believes based on her expertise. Okay, not being an accountant, being somebody in the advertising area. And again, she wants to, and she really feels that this is her contribution. It's an as-if scenario. All right. So what happens if we increase costs by fixed costs by $1,500? What happens if we're then able to sell those 500 additional snowboards? Okay. Let's go back to the original information. Okay. Again, what was the company's monthly income based on the previous sales? Remember, they were selling 900 units at $90 per unit, so their total revenues were $81,000. Remember when we looked at the variable cost, the percentage? Variable costs were 40% of the sales. So here, the variable costs at that level of production equal $32,400, and the contribution margin, which is 60% of the sales, remember we calculated that earlier, the contribution margin equal $48,600. Okay, so based on the previous, okay, the previous fixed cost of $37,800, okay, based on this volume of activity, the 900 units, they were able to generate operating income of $10,800. Okay. That's our starting point. All right, so now let's go. What happens if we look at the, if we incorporate the advertising executive's input? Okay, now remember, she believes that they're going to be able to sell 1,400 units, okay? If they increase their fixed costs by $1,500, okay, per month, okay, if they increase their fixed cost by $1,500, they are going to be able to sell 500 additional snowboards, right? So plugging those figures into the into the CVP equation we had earlier, okay, what happens now? Again, fixed costs plus the projected income divided by the contribution margin ratio is going to tell us what our projected sales are. Okay, if we're able to sell those 500 units and by increasing our fixed expenses. So what happens to our fixed costs here? Our fixed costs, remember, are going to increase by $1,500. Okay, the fixed costs were $37,800. So now our new fixed costs are going to equal $39,300. Okay. Now the projected operating income, all right, that's what we're trying to figure out. How much is our operating income going to be, okay, if we're able to sell the additional units? Okay, so now we have this equation, the 39,300 plus we're trying to figure out our projected operating income, and we know what our sales dollars are, our projected sales dollars. When we substitute it into that formula, 60%, again, we multiply both sides of the equation by $60,000, by 60%, and then add the 120, subtract the 39,300. Okay, what are we able to simplify this equation to? It basically tells us that our operating income, okay, our projected and it's projected, operating income if we sell 1,400 snowboards and we only increase our fixed costs by 1,500. What is our new operating income going to be? Our new operating income is going to equal 36,300. Okay, now that's a substantial increase, right? Because now the target figure here, the projected income now is $25,500 higher, okay, than the current monthly figure. Remember on the earlier slide, our net income was, our operating income was only $10,800 when we were selling 900 snowboards. If we're able to sell 1,500 or 1,400, I'm sorry, 1,400 in total, which is the 900 units we were previously selling, plus an additional 500 units the advertising executive is suggesting. Okay, how much is our operating income going to equal? It's going to equal 36,300, which is $25,500 more. Okay, so that's a huge increase. Remember, this is what the projections are. You can use CVP analysis for projections, okay, but again, you have to be able to justify these projections as well. They have to be realistic. Okay, so this is this individual's contribution, okay, where she'd like to see the sales going. Okay, now, however, remember, they're all sitting in a room and all the different executives are discussing this. Okay, but now the plant manager says, okay, she doesn't really agree with the advertising director's projections. Okay, he believes that the increased demand for the company is going to put pressure on the plant's production facilities. Remember, because they're basically saying they're going to produce an additional 500 units. Okay, and she's saying that only fixed costs are going to increase by $1,500. The plant manager actually believes that because the company is going to be using so much more additional labor in order to produce those 500 additional units, he believes that that per unit direct labor costs are going to increase by $1.80 per unit. Okay, so he's suggesting, in addition to what we just saw, that our variable costs are going to be increasing by $1.80 per unit, because of additional production and overtime that is going to result from producing those 500 additional units. Okay, now assuming that he is correct, he wants to know the sales volume. Okay, so now we're trying to solve for the sales volume that is going to be required, okay, to arrive at that that operating income figure of 36,300. Okay, so he's putting in an additional caveat. Okay, it's not, he doesn't believe only fixed costs are going to increase. He believes variable costs on a per unit basis are going to increase as well. So we just substituted, again, going back to our basic formula here, now they didn't say anything about sales price. So here they're holding the sales price still at $90 per unit, but now we're going to increase the variable cost by $1.80 per unit. Okay, so if you increase the variable cost by $1.80 per unit, remember it was $36 previously, you're adding $1.80 to it. So now the variable cost per unit equals $37.80. Okay, so what is our unit contribution margin? Remember, whenever you change the variable cost, you know you're going to change the contribution margin as well. Okay, so here we're trying to figure out the new contribution margin, which would be the sales price. We're not changing, that's still $90, minus the variable cost of $37.80. What is the new unit contribution margin? The new unit contribution margin is going to equal only $52.20. So going back, okay, to our projected unit sales, okay, to that formula, again, it's always fixed costs. Okay, remember our fixed cost increased also. It was 37,800. Then we added an additional 1,500, okay, to increase our sales. Okay, 39,300 plus our our fixed cost plus our operating income. Remember, we want to stay with an operating income of 36,300 under this new with the new contribution margin. How many units is this company going to have to sell if the variable costs increase per unit as well? Okay, in order to generate the operating income of 36,300, he suggests that they're actually going to have to sell 1,448 units, not just the 1,400 units. Okay, so again, each person in the different fields of expertise are coming in and they're adjusting, okay, their production analysis based on what their expertise is. Okay, all right, so that's the second person who was input into the production. Okay, then you have this last person, the vice president of sales. Now, the vice president of sales isn't convinced that an increase in the monthly operating budget of $15,000 is going to actually, so that the first proposition, that only increasing fixed costs by $1,500 is going to increase unit sales by 500 units per month. Okay, her estimate now is realistically, you're going to be only increase production by 350 units. Okay, so what is production in this proposal going to be? The 900 units that you started with, that's what you had. Now you're only going to be adding 350 units to your monthly production. Okay, so what is your new sales unit sales going to equal? The unit sales here realistically are only going to equal 1,250. Okay. In addition, she assumes that she agrees that the advertising budget has to increase by $1,500, and also that the variable labor costs are going to increase by $1.80 per unit as well. Okay, so now what she's saying is, all right, if we want to produce 1,250 units with the fixed cost and the variable cost increasing, okay, how much are we going to have to adjust our sales price by? Okay, so now she's looking to adjust the sales price, okay, to take into account the new production. Okay, again, go back to the same formula. If 1,250 units are sold each month, okay, the contribution margin again has to increase. Okay, and here they still want to stay with this targeted income of $36,300. How do we plug this into the formula? Here, what is the projected unit sales they have to have? All right, here we know they're going to sell 1,250. We know the fixed costs equal 39,300. We want our operating income to remain still 36,300. Okay, at that level of production, 1,250, what is our contribution? Now we're solving for the contribution margin per unit. The contribution margin per unit based on this level of sales is going to now equal $60.48. Okay, so now we're going to take the unit contribution margin and we're going to figure out what our unit selling price now has to be, because our contribution margin per unit changed. Okay, so here we know what our contribution margin per unit is, which is $60.48. We know the amount of our variable cost per unit, which equals $37.80. Okay, so if we add together the contribution margin, okay, contribution margin plus the variable cost per unit, okay, this is working backwards on the income statement. Contribution margin per unit plus the variable cost per unit is going to equal what? Is going to tell us our revenues per unit. So if we're going to sell 12,050 units, okay, with fixed cost increasing by $1,500, variable cost increasing by $1.80 per unit, what are we going to have to change our sales price to? Our sales price is going to have to become $98.28. Okay, so again, taking that same basic formula and just utilizing it based on different projections that are basically coming from management. Okay, all right. Everybody good with this? Any questions? All right. Again, always start with the basic. You start with the break even, then you can add any operating income. Again, once you understand those formulas based then on any projections, I'm not going to ask you for something this complicated, obviously. on the homework or in the on your exam, but if I changed one of these variables, you would have to be able to solve for that variable. Okay, and it would just be taking this particular equation here. Okay, everybody good? All right, again, we're going to go over problems in the homework related to this also. Remember, though, when you're dealing with a company that sells many products, okay, because most of the time a company is not just selling one thing like snowboards. Maybe they'll sell helmets, they'll sell gloves, they'll sell additional units. If a company is selling more than one product, okay, let's say this company was selling snowboards and goggles. Okay, what you'd have to do if it's more than one product, you'd have to figure out the average contribution margin, okay, for all of the products it sells. How would you figure that out? You would look at the contribution margin ratio for each of those products. So we just saw, remember here, how the snowboards had a 60% contribution margin ratio. Let's say snowboards are 90% of their total sales. That means that 54% equals the contribution margin ratio for snowboards, 54%. Then here you would have to also be told goggles, the product contribution margin ratio equals 80%. Then just multiply it by the percentage of sales. So you're taking the individual products contribution margin and then just multiplying it by the percentage of sales each of those products have out of the total sales dollars, and then you're just going to come up with a joint or an average contribution margin ratio. Okay, and this is only in the event that they sell more than one product. Okay, obviously you're going to have to do, and again, what is this? This is like the weighted average, right? The weighted average contribution margin if more than one product is sold, weighted average. Okay. Okay, now, Francisco, where are you? Now, this goes back to your question. What we've been dealing with in the break-even analysis, okay, we've been looking at, we were trying to project how do fixed cost and variable cost, how do they behave over different levels of production? Okay, remember that there's another type of cost that you have to consider, and that other cost is a semi-variable cost. Okay, remember that semi-variable costs have a fixed portion and they have a variable portion as well. Okay, so we can't graph it as easily. Okay, in practice, you're going to have to estimate the amount of the fixed and variable costs. One of the ways that you're going to be able to estimate it is this high-low method. Okay, so this is probably going to be similar to something that you learned probably in high school. All right, but just to go over again, the high-low analysis, again, applies only to semi-variable costs. Okay, so let's say there's some administrative costs, okay, that the company has to incur, and that administrative cost is semi-variable. It has a fixed portion and it has a variable portion as well. Okay, so here, this is what you would be given, okay? And for those 27 of you here, very good. There'll be at least one problem with this on the final. All right, so this company, again, Snowglide with the snowboards, basically has a semi-variable cost. It's an administrative cost, which has a fixed component, and it also has a variable component. All right, so what we're going to do, you're going to be given this information. So here, these are the different levels of production over this certain 6-month period. Okay, so here you're told the number of units that are produced, and this is the related administrative costs. Okay, now these are the total administrative costs. Part of them are fixed, part of them are variable. So we're trying to figure out how do these costs behave so that we're able to control them and predict them. Okay, that's what we're doing in CVP analysis. So what you're going to do here in the high-low method, you're just going to take the high point of production, which here, the high point of production is here, which is the 950 units. Okay, so the high level of production is 950 units that were produced in April. And what's the low level of production? The low level of production is going to be in February. okay, where they only produced 850 units. Okay, and what are we going to do? We're going to compare the related administrative costs, okay, for these 2 points in time. So remember, when you're doing a problem like this, you're not looking at the highest and the lowest costs, okay, periods for the cost. You're looking at the highest and lowest levels of production, okay. So here, 850 units. When 850 units were produced, we incurred administrative costs of $25,040. In April, when they produced 950 units, the high level of production, the administrative costs were $25,280. All right, so now, okay, so to be able to figure out what the variable portion is, okay, so you're going to take April, okay, which is the highest level of production, 950 units at this level of cost, okay, and you're going to then subtract from that the lowest level of production, which is the 850 units at this level of cost, okay, which we just got off the graph. So what's the change, okay, between these 2 points in production? What's the change? So the change is 100 units, right, between the low point and the high point. So, and what's the dollar change? The dollar change is $240. So if I take this $240 change, I divide by the change in the number of units, okay, that's going to tell me what my variable costs are. Okay, so $240 divided by 100 units tells me, okay, the $240 change divided by the 100 units tells me the variable costs here are $2.40 per unit. Okay, so now what can I do? I could take this $2.40. This is now, that tells me that's what my variable costs are. Okay, because again, those two costs changed at those two different levels of production because of the variable cost, not because of the fixed cost. So I'm going to take that $2.40 and I'm going to plug it either into my high point or my low point. Okay, so to figure out what my total, okay, to figure out what my total variable costs are, here I'm going to take the total cost at my high point, which equals $25,850. Okay, so here I'm trying to solve for how much my fixed costs are. Here, just plug into the high point, all right, so $25,280. And now I already figured out that my variable cost equals $2.40 per unit. If I produce 950 units times the variable cost of $2.40, I know my total variable cost, I know my total cost, and I know my total variable cost. Okay, so if I subtract my variable cost from my total cost, what is that going to give me? It's going to tell me what my total fixed costs are. Okay, so from this, okay, plugging in my variable cost figure into my equation, okay, I was able to figure out what my fixed costs are and what my variable costs are now. So what does that mean? What's the equation for this line? The equation for the semi-variable cost equals 23,000 plus in fixed costs, 23,000 in fixed costs, plus $2.40 in variable cost. Taking into consideration that equation, I could then figure out what my total administrative costs are going to be at any level of production. Okay, so let's say for this particular month or next month, we're anticipating producing 930 units. That's how much planned production we have, 930 units. So based on that production, my projected production, I know my total administrative, my fixed costs for administration is 23,000. Okay, I figured that out. Then I know my variable costs are going to be $2.40 per unit. If my production is estimated to be 930 units, my variable costs are going to be 2,232 units. What's my total administrative cost then going to equal? 25,232. And I could then figure out what my administrative costs are at any level of production. Okay? At any level of production, now I can figure out my semi-variable cost once I'm able to get a graph of what my cost equation is. Okay, so now we figured out how do you plot your variable cost, your fixed cost, and your semi-variable cost, okay, into your production horizon. Okay. Again, just to close, last two slides for CVP analysis. Again, there's certain assumptions under CVP analysis. One is that the sales price is going to remain constant. That's not going to change, okay, at least until later on when that becomes a different determinant. Okay, if more than one product is sold, remember we have to do that average sales mix. We have to figure out what the average sales mix is if there's more than one product. So Joshua, so if there were 1,000 units instead of 930, that's exactly right. You would just multiply that $2.40 by the 1,000 units, and then just add that amount to the fixed cost. That's exactly right. Okay, but the only thing is, when you're looking at the number of units, remember that the number of units that you're going to produce always have to fall within the what? Within which range? Anybody remember? Whenever we're dealing with different levels of production, the level of production always has to fall within, remember, within a certain area within that slope, within the relevant range. Okay, it can't be that skewed into, you know, too high levels or too low levels of production. Okay. All right. Also, fixed cost, again, sales price is going to remain consistent. Fixed costs are always going to be remain constant within the relevant range. Okay, and variable expenses are also going to remain a certain percentage of sales revenues within that relevant range. So here, the variable cost in our last example is always going to equal $2.40 per unit. Okay, and so another thing that we always assume in CVP analysis, and it's a little cut off here, it's point number 5. When we do CVP analysis, we always assume that any units that we produce, we're going to be able to sell. Okay, there's no inventory. Okay. And again here, just a good summary slide, slide number 2051. Just make sure you make a little note of it. Again, the contribution margin formula, sales minus total variable cost, the unit contribution margin. Okay, we know what that is, just on a per unit basis. Then we have the contribution margin ratio. So if we're trying to figure out sales dollars in units, okay, we're going to always divide by the unit contribution margin. Of the ratio, I'm sorry, in dollars. Okay, so here it's going to be, if we're trying to figure out sales volume in units, we're always going to divide by contribution margin in dollars. Okay, if we're trying to figure out the sales dollars, okay, to arrive at break even or a certain operating income, we're always going to divide by the contribution margin ratio to figure out sales dollars. Okay, and then the margin of safety, remember, simply actual sales minus break-even sales. Okay, in terms of dollars, that's going to equal your margin of safety. Operating, once you know the margin of safety, you can figure out the operating income at any level because you just multiply by the contribution margin ratio. And here again, you apply any change in operating income, you can figure out what that change is based on the change in sales volume times the contribution margin ratio. Okay. All right. And that is it. All right. Right now, what we're going to do, we're going to go over the homework for this chapter. And then if we have time, I'll give you just a couple of quick formulas that you have to know for chapter 14. And that's it. Okay, we are done with all the material this chapter, and then Thursday is going to basically function as a review. Okay, and of course it's going to be a review from the beginning of the semester. Okay, so now you'll really get to see how efficient this cost volume profit analysis is. I'm just going to increase the font a little bit. All right, so let's look at the first equation, okay? And the first one is beginning exercise 23. Okay, and again, this is more in line with what you could expect on an exam. All right, so here you're told that City Ambulance estimates the monthly cost of responding to emergency phone calls to equal $75,000. That's the fixed portion. And then there's also a variable portion, which is going to equal $200 per sales call. Okay, so this is the fixed portion, the 75,000, and this is the variable portion. All right. So first question, in a given month, okay, what is the total cost of responding to emergency calls when the number of calls equals 300? Okay, so again, all you have to do, remember, total cost equals fixed cost plus variable cost. I'm sorry, here the zero just got truncated and pushed to the bottom here. But here, if we're trying to figure out what the total costs are in a month where they have 300 calls, we know the fixed costs are going to be 75,000, right? What are the variable costs? We're going to take the 300 calls times the average call price of variable cost of $200 per call. So here for those 300 calls, we're going to have variable costs equaling 60,000. What are the total costs in that particular month when they had 300 calls? Total costs are going to equal 135,000. Okay, so just remember it that simply. Fixed cost plus variable costs equals total costs. All right, and then B, what's the average cost of responding to the emergency calls when they have 300 calls in a month? What's the average cost? Again, you're going to take the $135,000 in total cost, divide by the number of calls, which is 300. What is the average cost per call? The average cost per emergency call equals $450. Okay, so CVP is really like a quick, easy way to analyze costs and how they change over time, and how, and then again, what's the basis you want to be able to control those costs. Okay, and then letter B. Okay, this is an interesting point. Letter B. Assume that in a given month, the number of emergency calls was unusually low. Okay, would you expect the average price of emergency calls to be higher or lower? Okay, if the number, let's say it's in the summer, everybody goes away for the summer, there's not many people left in that particular town. Okay, what's going to happen to the average cost per unit? Is it going to increase above $450, or will it decrease? Okay, remember, once the level of production decreases, what's going to happen to that per unit cost? The per unit cost is going to increase, right? Because all those fixed costs that are incurred, the $75,000 of fixed costs that they have to pay regardless, okay, those still have to be absorbed by each particular unit or emergency call they make. So what happens when calls are unusually low, the number of calls, we know that the unit price per call is going to increase. Okay, does that make sense? Okay, if the average price during an average month is $450 per unit, if the number of calls decreases significantly, you can expect to see the cost per unit increasing. Okay, because you have less calls to divide those expenses over. All right. Okay, good. All right, and remember, I posted all of these homeworks too under materials for this class as well. Okay, so if you just want to look at the homework exercises and review them, you can find them there as well, or you can look here online. You just have to listen to the tape again. Okay, now here, the second equation, the second problem. Potter Company has fixed costs of $500,000, and variable cost of $32 per unit, and a contribution margin ratio, okay, of 20%. Okay, so again, when I'm comparing my contribution margin, dividing it by my total, by my sales dollars, I'm coming up with a 20% ratio. Okay, so they're asking us here to compute the following. Okay, the unit sales price and the unit contribution margin. Okay, so remember, we're told here that fixed costs equal 32,000. So let me just go back. Fixed costs here in this instance equals 500,000, sorry, and variable costs are $32 per unit. So variable costs are $32. Okay, and fixed costs are 500,000. All right, so just having that, and also that the unit contribution margin is 20%. So here, to figure out the unit sales price, again, this unit sales price equals the unit sales price, okay, we know the total revenues minus the $32 in variable cost is going to equal 80%, right? Because the variable cost, the contribution margin is 20%, and here we know the contribution margin. I'm sorry, I can't read this. Okay, so the contribution margin ratio is 20%. That means that the variable costs are 80% of the sales price. So if the variable costs are $32 and it's 80% of the sales price, what does that mean? What is the total sales price then? The total sales price is going to equal $40. Okay, because we know this $32 equals, so we're going to take the $32. Okay, and we know the contribution margin, we're going to divide the $32 by 80%. Okay, and that means that therefore that to figure out 100%, then we know that 100% or the unit sales price is going to equal $40. Okay, so if we're trying to figure out what the unit contribution margin is, remember the unit contribution margin is the unit sales price minus the variable cost per unit. So here, if we take the sales price, which we just figured out $40 per unit, minus the variable cost of $32, which we're given, that means that the unit contribution margin in dollars equals $8 per unit. Okay. Oh, here, let me see. Somebody has a question. So the fixed costs do not have anything to do with the unit sales price. Well, the way you have to think of it, Joshua, is that the fixed costs remain fixed. Okay, so once you figure out what percentage of the variable cost is, and you know the amount of fixed costs that you have to absorb, then you could figure out what your total sales dollars are. So here, the way this was framed, it was a little different. Okay, so here we knew what our variable costs were, right? Our variable costs were $32 per unit, and we knew that the contribution margin then equals 20%. So if the contribution margin, okay, is 20%, that means total sales dollars minus variable cost, that equals $20. That means how much is being subtracted from total sales dollars for variable cost. You knew that variable cost had to equal 80%, okay, of total of unit sales price. Okay, so we just in cost volume profit analysis, you're going to be doing a lot of plugging of figures. Okay, so we knew here that basically the unit sales price. Let me type it in. So in this instance, based on the given information, we knew that the unit sales price minus the variable cost okay, equals the contribution margin, right? Right, that's our given formula. All right. Now, if we're told, okay, that the contribution margin for this particular problem, if the contribution margin is now 20% per unit on a per unit basis, and of course then in total, we know then that our variable costs, right, have to equal how much? Our variable costs have to equal 80%, okay, of the unit sales price. Okay, because we know that the unit sales price or the revenues equal 100%. Okay, so if we know that $32 is the amount of the variable cost, we know that if we divide to get to 100%, which is the unit sales price, which we're trying to solve for here, if we take the $32 and divide by 80%, we can then figure out how much 100% or the unit sales price is, which here we determined that it was $40 per unit. Okay, then once we figure out what the unit sales price is, we know if we take the $40, we subtract the variable cost, which we were given of $32. That's then going to tell us what our contribution margin per unit is. Okay, so we're always looking at fixed costs do apply, but here again, in this particular example, we can figure out if we're given the contribution margin and the variable cost, then we could figure out the unit sales price. We can do it on a per unit basis for just using the variable costs. Okay, if we're though trying to figure out what the break even, okay, what the break even is, then we're going to have to figure out what we're going to have to include the fixed cost then. Okay, is that good, Joshua? Okay, so here then, once we figured out, all right, once we figured out what the unit sales price was, here letter B, what's the sales volume that's required for Porter Corporation to earn income, operating income of $900,000. Okay, to earn $900,000, what is the sales volume in units? So remember, to figure out the sales volume in units, what's the equation? You go here now to figure out the any sales volume. You always have to figure out. You always have to include the fixed cost. So fixed cost plus the targeted monthly, the targeted operating income divided by the unit contribution margin, again in dollars, right? If we want to figure out volume in units, we have to divide by contribution margin in dollars. Now we have all that information. The $500,000 in fixed cost plus the $900,000 in operating income that we want to generate, divide by the contribution margin per unit in dollars, which is $8. We just figured that out up here. We figure out how many units do they have to sell in order to generate a profit of $900,000. They have to sell 175,000 units. Okay. And then C, what's the dollar sales volume for Porter Corporation to earn an operating income of $900,000? Now, in this instance, we just could have taken a shortcut. We could have just taken the $175,000 units that we had to produce to earn that operating income and then multiply by the sales price, which is $40 per unit. Okay, but remember, you still have to know how to, if you didn't have all that information available, you still have to know how to figure out sales volume in dollars, to figure out total sales volume in dollars in order to earn a particular operating income. Remember, fixed costs in the numerator plus the targeted income, but here you're going to have to divide by the contribution margin ratio, okay, to figure out the sales volume in dollars, which is here it is the sales contribution margin ratio equals, what did I say it was here? Equals the contribution margin rate, equals 20%. Okay, so here, what did I do? I took the 175,000 units, multiplied it by the $40 sales price, it has to equal $700,000. Okay. All right. All right, any questions? Or I could have taken that same equation, the fixed costs, and here another way to solve is take the fixed cost of $500,000 plus the targeted operating income of $900,000 and divide by the contribution margin ratio, which equal 20%, and you would have come up with the same amount, which is the $7 million in sales. Okay, so you have to know how to come up with that number both ways. In dollars, unit sales in dollars and in sales. Okay. And then let's do again, and this is again what you can expect, all right, in any of these equations, in any of these problems. Let's take the next example. Jackson Company recently calculated its break-even sales to be $32,000. So that's their break-even sales. For each dollar of sales revenue, 75 cents goes to cover variable costs. So you know 75 cents goes to cover variable cost. You know that 25 cents of every dollar goes to cover the contribution margin. Okay, so here it's asking us to figure out what the contribution margin ratio is. Okay, so again, we're going to substitute in the break-even sales. So break-even sales equals $32,000. Here, where we don't know what the fixed costs are. Okay, but to figure out, I'm sorry, here, let's do A first, the contribution margin ratio. Here, sorry that the way this printed, if variable costs are 75% of sales revenue, that means then that the contribution margin ratio has to equal 25%, right? Okay, because we know that sales dollars always equals 100%. So here now we know our contribution margin and also our variable cost percentage. Okay, so B, calculate total fixed costs. So here we're trying to solve for fixed cost. We know this is our equation for break-even sales volume. Okay, so we know here what our break-even sales are, which are $32,000. Okay, that's what we're given. We're trying to figure out what our fixed costs are. Okay, so to figure out what our fixed costs are, and we know that our contribution margin ratio equals 25%. We just solved for that. So what in solving for this equation, if we multiply both sides by 25%, okay, $32,000 times the 25%, what do our fixed costs then equal? Our fixed costs are going to equal $8,000. Okay, at break even, what are our fixed costs? And actually, for this equation, what are our fixed costs? Our fixed costs equal $8,000. Okay, and letter C, the sales volume that would have to be generated to earn an operating income of $40,000. Here, again, just plug into the figure, fixed cost plus the targeted income, operating income, which is $40,000, divided by the contribution margin ratio. Again, always follows the same format, $8,000 fixed cost, $40,000 in targeted operating income, divided by the contribution margin ratio of 25%. Okay, what is our sales volume then going to equal? Our sales volume is going to equal, oops, I think it got cut off here. I'll just figure it out for you. Sorry about that. The slide just cut it off. $48,000. $48,000 divided by 0.25. That means our total sales dollars, okay, have to equal $192,000 in order to bring us operating income of $40,000. Okay. All right. And then here, I have one other problem here, which is exercise 27. I'm going to leave you, again, just a repetition of what we just did. So I'm going to leave you just to review that problem on your own. Okay, and it's basically, it's very standard. This is what you could expect, again, to be responsible for on the exam. And we have a couple of minutes. What I'd like to do, all right, so what I'm going to do now, so that's what you have to basically cover for this particular chapter. All right, and then I'm just going to show you, take 5 minutes just to show you what you need to know for chapter 14, and then we're done. Okay, so then I'm expecting everybody to show up, okay, for Thursday's class. It's in your best interest, again, because we are going to go over, just do a review since the beginning of the semester. So what do you have to know for chapter 14? Okay, what you basically have to know in chapter 14 is what comparative financial statements are. Okay, so when if I ask you what are comparative financial statements, and we're used to this again when we're looking at financial statements. Here we're just looking at an income statement. Comparative income statements are always just going to compare several years of activity side by side. Okay, so comparative income statements basically show financial information for more than one period. Okay, and they're going to show it on in one you would expect to see it for the income statement and then also for the balance sheet. You know, whenever you have a publicly traded company, it's not just going to show you the current year's results. It's really not meaningful. You're always going to have to compare the current year's results to previous years. Okay, and again, when you have these comparative financial statements, it helps you look at any developing trends. Like here, you would see that net income is increasing over time. Okay, it's decreasing over time actually from 50 in 2016 to only 40 in 2017 to 36 in 2018. So this is a trend that you would see developing. You see expenses are increasing over this time as well. So you'd look to see, okay, what does this mean? Okay, even though revenues are increasing, okay, our expenses are increasing so significantly, we see the trend in net income is decreasing. All right, so that's what you would see in a comparative income statement. Okay, that compares with something that is called, which is a classified financial statement. So when we look at classified financial statements, okay, on a classified balance sheet, okay, what you're going to see is that you're just basically going to group the different types of accounts together. So on a classified balance sheet, you're going to see a subtotal for the current assets, and the next subtotal for plants and equipment, and then a subtotal for other assets. Okay, then for that would be how the assets are divided. Then you would also expect to see the liabilities divided as well. You would see first a subtotal for the current liabilities, then a subtotal for the non-current liabilities, and then you would expect to see shareholder equity below that. Okay, so if here, this is what a classified balance sheet would look like. Again, you would see all the current assets listed first. Then just a subtotal. It's classified by the length of time the asset is expected to be held by this company. So here, total current assets equal 180,000. Then you'd have the next subtotal for long-term assets or for plant and equipment. You see the total for long-term assets and equipment equals $280,000, and then you'd have another subtotal for all other assets, okay, land that they're holding for a different site. So a classified balance sheet just separates the current assets, the long-term assets, the current liabilities, long-term liabilities. It's just dividing up, and again, it's up to each company, okay, or corporation, how they want to prepare. GAAP does give you some different alternatives as to how you can present your financial statements. Okay, and this is what the liabilities section would look like. If you were doing a classified balance sheet, you would just have a subtotal here for the current liabilities, another subtotal for the long-term liabilities, and then a subtotal for shareholder equity. Okay, then just in terms of the ratios, okay, a couple of ratios that I want you to know. Okay, for the final, well, the first one is a dollar amount. Actually, I want you to know what working capital in a company is. And remember the working capital. And again, when you use a classified balance sheet, it makes the calculation of working capital and any of these ratios a little easier, because here, what is the formula for working capital? Just current assets less current liabilities, and that's going to give you a working capital figure, which is a dollar figure. Okay, so I want you to know working capital. I want you to know the current ratio as well. And again, the current ratio just basically gives you an indication as to how well this company is going to be able to pay off their current liabilities. Again, the formula for the current ratio is current assets divided by current liabilities. Okay, and the current ratio here would be 1.8 to 1. Okay, comparing current asset. You always want, again, you always want a positive current ratio. You want your current assets to be greater than your current liabilities. All right, and remember, that's what accountants do. They do analyses, and they do analyses by doing the ratios. And then the last ratio really that you need to know for the final is the debt ratio. Okay, and the debt ratio just tells you what this company's ability to pay off its total debt or its long-term debt equals. So here, the formula for the debt ratio is just total liabilities divided by total assets. Okay, so here, and again, you want your total debt ratio to be lower, right? Because the lower, that means the lower the debt ratio, the better able this company is going to be able to pay off all of its outstanding debt. So here, the debt ratio for this company, you're going to take total liabilities divided by total assets. Again, you would get this from the balance sheet, and it tells you that the debt ratio here is 33 1/3%. Okay? And that is it, guys. That is it for all the information that you need to know for the semester. Again, we're going to meet again on Thursday. Again, my view of homework is better late than never. So if some of your homeworks are still outstanding, again, it's going to help you in your review of all the materials. I would look to still do any outstanding homeworks as well. Okay, so unless there are any other questions, I'm going to end the class here, and I'll see you all again on Thursday. Okay, and the midterm, the final is going to be next Tuesday. All right, so everybody have a good day. Stay healthy, stay